Hello traders, and welcome to another video. Are you looking for one of the best and simplest ways to trade the markets? We will be covering a powerful strategy with relatively safer entries that will probably increase your confidence in your trading. So let's get started, traders. Using the candle's breakout strategy for placing trades provide one of the simplest ways of trading setups in the market. While the candle breakout strategy might have a few downsides, for example having a lower risk to reward ratio, so the losses could often be bigger than we want them to. This strategy still provides more entries and possibly safer entries than using more complex strategies. Before going deep into explaining and trading the strategy, we need to understand the mind games, psychology, how and why it does work. To increase the chances of entering high-quality trades in smart money concepts, we follow certain rules. For example, we wait for price to hit key levels on high time frames. These key levels can be smart money structures like demand zones and supply zones. Once the price has hit the key structure on the high time frame, the next step is to zoom into the lower time frames and spot smart money reversal patterns like the market structure shift or change of character. As an example, we wait for price to break above this lower high, which should confirm the validity of a smart money entry like an order block. Now, the problem traders often find themselves into is the market shifted happening too far from the validated order block or demand zone, and the market rarely just drops in a straight line that significantly after already confirming a reversal. So traders are often left missing out because they want to open a position only on the demand zone. There are two solutions to this problem. The first one is to position the orders on the fair value gap or imbalance if the price has moved too aggressively, leaving pricing and volume inefficiencies on the chart. Therefore, we can place a pending order on the fair value gap, with the stop loss below it, and take profit depending on the market's structural levels. But usually I look for minimum 1 to 2 risk to reward trades, and 1 to 3 being my favorite one. You can also look for higher risk to reward ratio, but to avoid price going up and then reversing into the stop loss. You could take partial profits, for example 25% profit at 1 to 2, then another 25% at 1 to 3, and so on. However, what if the price is increasingly gaining upwards momentum and the pullback ends higher than the fair value gap, leaving traders that have orders in the right direction with their orders being unfilled, so basically they haven't managed to capitalize on a trade they had convinced in? And this is when comes the second solution of the smart money entry. On this option, we will focus on the high time frames and apply the candle breakout strategy in our trading system. Let's explain the details of the candle breakout strategy. Spotting the breakout. The first step involves spotting or identifying a breakout of a key smart money structural level on the chart. This breakout is typically indicated by an engulfing candle that price breaks an important zone with an increased momentum. The engulfing candle breakout. The breakout happens when the engulfing candle is formed, indicating a reversal and decreasing momentum. This candle pattern completely covers the previous candles, indicating a constant aggressive movement in price. The time frames used, this strategy can be used on multiple time frames, but we found out it is most efficient and effective on the higher time frames. That's mainly because the higher time frames movement are more backed by more liquidity and volume, which supports more good quality setups and less false breakouts. This strategy comes with its pros and cons. One advantage is that you will likely have more trading opportunities, less time required to watch the charts since it's a pretty straightforward strategy with not too many variables to look for. It can also be a consistent strategy that can be traded in the long run, once you manage to profit from every advantage and minimize most of the disadvantages that you can. The cons of this strategy are being more exposed to fakeouts, since you don't need to look for many combinations of patterns and variables to confirm the highest quality setup. Another disadvantage is this strategy comes with a large stop loss, which is defined by having a lower risk to reward ratio, leading to more or less frequent losses, but they take a higher part of the profit than other higher risk to reward strategies do. Let's explain the details and entry rules for this trading strategy. The entry should happen on the breakout of a key smart money level identified on a high time frame order block supplier demand zone. Now let's dive into presenting an example on how to implement this trading strategy. We have a bearish market structure on the high time frame. We notice how price has built up liquidity above the equal highs, as we have explained it on our previous video. The equal high is a liquidity trap for retail traders. By price going into the same high levels, retail traders are constantly opening short sell orders. They don't expect price to break up the highs and instead want the price to break the lows first. So them placing their stop losses above the equal highs, a lot of liquidity is being pooled at similar prices, causing institutions and smart money to take out their liquidity and move the price into their desired level, which is the supply zone. After price hits the supply zone, the most common reaction is a pullback. The price action inside the pullback will indicate if the price can break the supply zone and reverse into an uptrend, or indicate a rejection and continuation of the downtrend in which we can look for selling opportunities. We do not open a trade blindly when it touches the zone. We want to analyze the highest quality confirmation. To analyze the situations, we must look at the candle formation once the supply zone has been hit. Firstly, we want to see the initial candle that approaches the supply zone. We then want to see the reaction candle, which is the candle that usually rejects down with a wick or shows loss of buying momentum. The reaction is not necessary to be indicated just by a single candle. It can also be shown by multiple candles, but remember the most important detail is that price rejects the supply zone and loses buying momentum. And then we want to see an engulfing candle that covers the previous 1, 2, or multiple candles. An extra detail is if the engulfing candle has a wick that breaks the previous candle's high. It's the highest indication of a rejection. The wick usually means it has successfully liquidated many trades and price is ready to continue the downtrend, but the wick is not always necessary, just an extra very strong confirmation that we might rarely meet. Let's go to some details that we need to know before using this trading strategy. As we have mentioned before, this strategy can work in all time frames. The key word here is can, because ON might also see this strategy to work in lower time frames, but are likely to meet more false signals, more breakouts of the zones. So the best time frames to use it is on the higher time frames, like the 1 hour and above. The higher time frames will respect the zones more often than they do on lower time frames. What we also should know, and it's really important, is that we need to wait for this pattern to form and look closely once the price hits the supply, demand, order block, or fair value gap zone. Make sure to notice things like if the price had a reaction when touching the zone. What was the reaction? And make sure the zone hasn't already been used in the best, because some smart money structures like the order block and fair value gap shouldn't be used the same structure twice. Once these structures fill, we call them mitigated zones. Let's jump into the charts. This is the euro-dollar on the 1 hour time frame. Starting from the left of the chart, this was initially a bullish market that reversed into a downtrend by this large downside movement. We had this ascending trend line with resting liquidity below it that has been taken by the significant bearish movement. Why it's important to know? Because we always need to have liquidity in mind. The more liquidity structures have been taken, the more active smart money institutions are on a market. And the more active they are, the more chances for us to follow their footsteps and use them into our advantage. The downtrend confirms by the break of structure to the downside that leaves a supply zone in which large sell-short positions have been opened. These traders need liquidity to enter such trades, and they often split their trades into smaller multiple ones. So what they want is for price to come back to the supply zone to open their second order. Us knowing that we have patience for price hitting the supply zone, but until then, let's check how price action behaves. Essentially, the markets are breaking structure to the downside, a common fundamental of a downtrend, but then it leaves another smaller supply zone. Would you take a trade on this supply zone? I prefer to not take trades on internal supply zones. They can still be used by following more complex concepts, but in this video, we want to make things as simple as possible. So in that case, we will only look for external structural zones, such as the external supply zone from this example. Price here created equal lows, with liquidity from buyers' stop losses sitting below that shortly have been taken down, and the price just shoots up to the upside, completely breaks the internal supply zone. This is called an inducement. It is a well-placed smart money structure that is used to trick traders. It is what usually happens with internal zones. But again, they can be used under certain conditions that we will explain in other videos. But even if you have had sell shorted this, as we usually say, the stop loss is around right above the zone, so you would have not lost that much risk to reward-wise. But then, price hits the external supply zone, and the pattern that we have talked about prints on the chart. The first candle to approach the zone, the single or multiple candles that touch the zone. And the final is the reaction candle. In this case, the reaction candle even took the liquidity of the previous equal highs, which, as we have said before, it is one of the biggest indications of a high-quality setup. We look too short at the close of the reversal candle that broke all the first and second wave of candle formations. Stop loss above the supply zone. Take profit. We look for price to create another break of structure to the downside, since this is a downtrend price action on the higher time frame. And that's it. Another example. From the left, we can easily analyze in the first few seconds and understand that market was in a downtrend. There is a descending trend line with resting liquidity from the stop losses of short sellers. Liquidity that has been taken by this impulsive upside movement. This upside movement breaks the previous high of a downtrend, marking the change of character and trend reversal into a potential uptrend. This confirmation validates the demand zone that made this move happen. So we wait for price action to approach the demand zone. In this example, this is the candle that approaches the demand. This is the candle that hits the demand, and this candle with the next one represent the reaction candles. So we look to buy at the closure of the candle. Stop loss below the demand zone. And since the trend has reversed into an uptrend, we now look for break of structures to the upside. So take profit is right above the previous high. That's it for today's video. Thank you for watching and see you on the next ones.